The Australian city of Darwin, Christmas Day 1974. The excitement of Christmas was turned into stark horror as the killer wind of Cyclone Tracy struck in the night and ripped the city apart. These winds, which started at 2 a.m., hit with the force of over 200 kilometers per hour. Trees were ripped from the ground, cars overturned and power poles brought down. Residential areas were flooded. Eyewitnesses reported that the air was full of flying debris, particularly sheets of corrugated iron. An army report described the city as looking as though it's been hit by an atom bomb. The death toll was 66 and more than 1,000 were injured. Up to 30,000 of the population of 48,000 were reported as being homeless, and there was no power and very little food and fresh water. Somehow the city had to be rebuilt. Somehow the people living and working in the surrounding community had to be compensated for loss of property, earnings and cost of injury. In the same year, on the other side of the world in England, the nitrochemical plant at Flixborough caught fire, exploded, released toxic fumes and eventually was reduced to a tangle of hot steel. As a result, 20,000 people were evacuated from their homes. 28 people died and 89 people were injured during this disaster. Up until 1974, it was the largest single loss of its kind the United Kingdom had ever seen. But the damage caused was nothing compared with some of the world's natural catastrophes. Since that time, there have been numerous disasters from catastrophes of nature, losses from man-made structures, and terrorist acts. In all the world's major and minor disasters, reinsurance plays a vital financial role. Which leads us to the question, what is reinsurance? When insurers accept a risk long before any accident happens, they don't keep it all. The risk is spread by offering a share of it to the reinsurance market. The reinsurer may pass a part of this share to someone else. In fact, it all becomes quite a complicated web that embraces reinsurers throughout the world. The risk is spread so far and wide that for each insurer and reinsurer, that risk is reduced to a manageable size. It's impossible to tell accurately just how many reinsurers are involved in these massive claims. But in the Flixborough plant example, we can get some idea from the fact that the main or lead insurer, whose share was only 15%, ceded or shared out its risk to more than 300 reinsurers. If the other 15 direct insurers did the same, then that comes to more than 5,000 cessions, or risks shared, and that's not at all unusual. The Piper Alpha oil drilling rig loss was even more complex than that, with reinsurance spiraling upwards so that the actual amount of money transacted on the loss was far in excess of the actual physical damage loss. So with such widespread business, you might well ask, how is it all arranged so smoothly? Insurance companies can buy from reinsurers directly in some markets. It is, however, often transacted through an intermediary or reinsurance broker. There are reinsurers all over the world, but London predominates. It's the world's most active reinsurance market, where international reinsurers cluster together in a tightly knit community in one part of the city and lead the innovation in reinsurance. Brokers and underwriters meet and make agreements to insure and reinsure. One of the reinsurance market's guiding principles, in fact the bedrock of its foundation, is utmost good faith or trust. Complete faith that the reinsurer who promises to pay the agreed sum at the required time will do just that. Reinsurance is a very old business. It's developed special techniques to ensure quick, efficient, and dependable cover to the insurers. The claim settlements for many catastrophes and large risk losses are dramatic examples of the reinsurance market in action. But reinsurance is concerned with all risks, great and small, from a complex multi-million-dollar risk down to the more normal risks of everyday life. Aircraft passengers, workers in factories, shops and offices throughout the world, motorists, to name a few, all require insurance. All are insured against liability and supported by reinsurance. Individual policies that insure house and contents, car and life assurance to support spouse and family in the event of death are all reinsured in some manner. On the land, in the air, on the sea, and even in outer space, vehicles of every size carrying cargoes and passengers. oil rigs, vast costly structures that carry a nation's lifeblood. All are insured and reinsured. But reinsurance is not about order. It's about disorder. Not about calm, but catastrophe. Of planes crashing, ships sinking, explosions and natural catastrophes. People die naturally and people die violently. This is the scope of reinsurance. In every field of human endeavor, reinsurance is the last resort against catastrophe. When things do go wrong, the international markets of reinsurance provide the structure where the losses of the few are shared by the world. But how does this structure work, and how did it all begin? To understand the evolution of the reinsurance industry, we need to go back a few centuries when the world was being discovered and trade was growing. Trade was risky then as it is now. Ships were small and likely to be wrecked in storms, pirated or lost in uncharted seas. Merchants minimized risks with good ships and crews or by pulling out of business altogether. Alternatively, they attempted to arrange some sort of compensation if the shipment never completed its voyage. In other words, they arranged insurance. Merchants who were successful in similar lines of business and who were prepared to risk their reserves of capital provided compensation against loss for a price. These merchants required details about the risk. What sort of cargo? What sort of ship? How old was it? Where was it headed? And by what route? Was it suitable for this type of cargo? Who was the captain and how good the crew? All these details and more the merchant would need to know so he could decide how great a risk he was insuring. At first, insurers kept all the risk to themselves, but as trade grew and the risks became greater, they were forced to share the risks with others. And thus, reinsurance was born. Just as the original merchant gave details of the risk to the insurer, so now the insurer gave the same details to the reinsurer. In return for accepting some of the risk, that individual would get a share of the price known as the premium. It's the same today, and it's called facultative reinsurance. That is, reinsurance for each individual risk. However, just like his medieval predecessors, the modern reinsurer can accept or reject each individual risk offered to him. He assesses each risk on its merits, and therefore master of his own business. Facultative reinsurance worked well for a few hundred years, though these days it's generally only used for part of a risk, or large value complex risks that cannot be reinsured in any other way. Since the Industrial Revolution, trade and life in general has become far more complex. Facultative reinsurance was too cumbersome to cope. It took time and money to draw up the details for each individual risk, and it was not always certain that the reinsurer would accept the risks. Without a guaranteed backup from the reinsurer, the insurer was unable to expand his business. Reinsurance had to be streamlined. The foundation of reinsurance, as mentioned earlier, is based on trust. As business grew, insurers and reinsurers who trusted each other made trade agreements. These agreements are known as treaties. They enable the insurer to reinsure all risks of a certain class automatically without going into too much detail. But most importantly, guarantee that the reinsurer accepts those risks. So, a reinsurer who accepts a treaty with an insurer for industrial fire risks, for example, must take on all the risks of that class offered to him. This is known as treaty reinsurance, and in its various forms is the basis for most reinsurance today. The most important point to remember is that the reinsurer has no choice in the matter once he's accepted the treaty. He's legally bound to accept all that's given to him within the terms of the treaty. Equally, the insurer must give, that is, cede, all those risks within the agreed categories to his reinsurer. There are a variety of reinsurance treaties. They are categorized as proportional treaties or non-proportional treaties. Excess of loss is often used synonymously with non-proportional. Let's look at proportional treaties. Imagine there's a treaty between an insurer and a reinsurer for, say, householders insurance. Under a quota share treaty, an agreed proportion of the risks on the dwelling would be automatically reinsured. The reinsurer would receive the same proportion of the premium. Under the terms of the treaty, the insurer might agree to cede half of his householder insurance to the reinsurer, who would therefore receive half the premium. In this example, the share is 50%, but it could be other percentages when the quota share treaty is negotiated. Consequently, if any dwelling was destroyed, the insurer would meet the claim and would, in turn, claim from the reinsurer. So if the claim was for $500,000, the reinsurer would contribute $250,000 and the home rebuilt. His share is 50% in this instance, but this percentage, as mentioned earlier, is determined when the quota share treaty is negotiated. A surplus treaty works differently. Not all buildings are the same. Take a drive around any town or city and you might see a supermarket, a timber yard, a library, an office block and a printer. Different buildings are devoted to different uses and built of different materials. Some are greater risk than others because they're more likely to burn down. Hence, the insurer would probably prefer to keep a greater share of the risk on the office block than on the timber yard. But the quota share treaty in our previous example doesn't allow for that. The insurer was required to cede half of every risk, irrespective of the nature of the building. The surplus treaty solves this problem. This type of treaty enables the insurer to retain more of the risk. He need only reinsure the remainder, hence the term surplus treaty. This type of treaty is generally used for the larger risks where millions of dollars might be involved. So let's assume that the timber yard and the office block are both insured for $10 million. The insurer might want to retain $1 million worth of risk and cede the remaining $9 million of the timber yard. But on the less risky office block, it could well be the other way around. That is, the insurer might retain $8 million worth of risk and cede only the surplus $2 million. The insurer might well have several timber yards under his different policies. It would be good business for him to pass on as much of the risk as possible, keeping only a small part of the risk for himself. But that would be bad business for the reinsurer and unfair. In fact, within surplus treaties, the amount of risk the insurer can cede is limited to a multiple of his own retention, called a line. For example, given a $10 million risk and the insurer retains a $1 million line or retention, and they've arranged a 5-line treaty, our insurer can cede only as much as 5 times this retention. Hence, our insurer can only cede $5 million of the risk. The insurer is obliged to seek elsewhere to reinsure the remainder. It's only a 5-line treaty in this example, but there can be as many lines in a treaty as the two sides wish. Reinsurance has become more flexible in recent years, and treaties now accommodate graded retentions.
I'm a reinsurance broker. I entered the insurance industry some time ago. My job is to select my markets, knowing which reinsurers have which capacity available for which classes of business. I have to have a thorough knowledge of both the business I produce for the reinsurer and the various countries from which this business emanates. This knowledge is built up on a personal basis over a number of years and is an inherent part of the broker's skill. Most brokers join a company and learn the various basic aspects of reinsurance in the back room. As they become more senior, they develop business connections by visiting different countries, negotiating complex renewals, making quotations and creating conceptual plans. The world markets are changing dramatically, and it's our job to stay abreast of these changes and to advise our clients accordingly.
So, David, what's on offer?
Well, there's a surplus treaty from Asia to place.
A property treaty?
Yes, from the Fortune Insurance Company.
Don't know them. What are their credentials?
They're a subsidiary of the large Japanese bank. They've been operating for about 20 years. Good management team, plenty of experience. Their general manager's here next week. I think you should meet him. Here are some annual reports and details of their profit and loss account for the current year to peruse.
Thanks. What's the nature of the treaty?
Oh, it's a property surplus treaty. Fortune Insurance are taking a retention of $4 million US maximum probable loss. They're seeking a capacity from the treaty of $20 million US MPL.
Oh, I see. A 5-line treaty. What's the minimum MPL? And do they have a good estimation of premium income to the treaty?
Well, they're currently estimating $35 million US. The minimum MPL they're proposing is 50%. They have a an engineer in charge of their underwriting, so that shouldn't be a problem, should it?
Well, the treaty appears fairly well balanced with this sort of income against capacity.
Absolutely.
Are you happy with the proposed commission rate?
Well, they're asking a commission of 35%, and the statistics seem to justify that percentage. I know, however, your reinsurers may wish to have a sliding scale.
Yeah, appears a bit high to me. We'd only be willing to offer 5% over their acquisition costs. We'd also need to look at their aggregates and risk profile, see if any cap needs to be placed on their natural peril exposure. We may also consider an event limit.
Fair enough. The commission is within your parameters. I presume you'd require the standard exclusions?
Yes, non-property risks and liabilities. Would also exclude energy risks.
Ah, yes. Well, so what sort of share can you manage?
Well, 20% line on this contract is, we're going to lead the treaty.
Well, that's good. Well, I'll call you to arrange a meeting with the representatives of the company for next week.
Now that the underwriter and the broker have reached an agreement, the underwriter stamps and signs a reinsurance slip, noting his line and entering a code number. Formal treaty wording documentation will follow in due course.
Thank you. Now, I've also an excessive loss treaty for a different company's motor vehicle account. The property damage, not the liability.
To be honest, we're not really looking for any motor exposure in the region. Try the XYZ reinsurer.
No, fair enough. Well, I'll do that. Okay.
The broker doesn't mind being told that the business is not desired. The broker's job is to understand his reinsurance market and know which companies will be able to help him. Therefore, he must go to another company who specializes in this business and who'll be able to offer him a good leading line. Thus, surplus and quota share treaties are arranged for specific proportions of the amounts at risk. They are called, as mentioned earlier, proportional treaties. But life is not always that simple. Injured passengers who successfully sue motor vehicle drivers for compensation are ultimately paid by the insurance company. It's often a considerable amount, and the insurance company has no control over the size of the loss. If you were an insurer underwriting a large volume of motor vehicle business, you face the possibility that a multiple vehicle pile-up could cause enormous compensation claims. The chances might be small, but it happens. Enter the reinsurer, who agrees to pay losses in excess of a predetermined amount in return for a premium. This is called a non-proportional or excessive loss treaty. In this type of treaty, the insurer meets all claims below an agreed sum. Only if the claim exceeds this agreed sum does the reinsurer pay out. There's a limit to how much the reinsurers agree to pay, and each underwriter will decide his maximum commitment according to his underwriting capacity. There are two major differences between proportional and non-proportional treaties. With non-proportional reinsurance, the claim recoverable from the reinsurer is not in the same ratio as the premium ceded to the reinsurer. The parties agree a price for the class of risk, which is normally expressed as a percentage of the total premium volume, called the GNPI. The reinsurer does not always pay whenever a claim is made, but only pays when the losses exceed the agreed sum. This agreed sum is called the deductible, or excess point.
We have here a property excessive loss contract on a motor vehicle account for the Phantom Insurance Company. But note the treaty doesn't cover the liability aspect of the motor vehicle policy. Coverage is $4 million in excess of $1 million.
Right. All the necessary clauses associated with the property exposure. What's their premium income?
Approximately $8 million, estimated to be $10 million for next year. The account is split 50% commercial vehicles, 50% private vehicles. This attachment shows the main aggregate exposures.
What about their largest losses and some triangulation stats about loss development?
Well, they had a fairly large loss 2 years ago, which has affected the 92 layer, but apart from that, they've had reasonable experience. The largest loss was caused by the cyclone. Other losses show normal development. Remember, there's no third-party liability exposure to this treaty, so no requirement for stats.
Oh, yes, of course. But we would require the company to take a co-reinsurance line of 5% on this business.
Yes, well, they may not wish to have that. However, I do understand your position on co-reinsurance.
The rate we calculate is 5% of GNPI. that develops $500,000 or 12.5% rate on line. And we would expect the minimum and deposit premiums to be settled quarterly.
Okay, fine.
Well, we can assist you here with a 15% lead line.
The negotiation with this company concludes in a similar way to the previous meeting. The reinsurer signs the slip, knowing that formal documentation will follow. Thus, excessive loss reinsurance is called non-proportional to distinguish it from proportional quota share and surplus treaties. Non-proportional treaties are a particularly suitable safety net for the insurer. They're ideal for large liability claims for motor vehicle, public liability and employers' liability business. They also protect the insurer against catastrophic claims from incidents like Cyclone Tracy that destroyed Darwin and other natural catastrophes. Natural disaster can produce claims under many different policies issued by the same insurer. That is termed accumulation of risk, where all claims of an insurer from one such event can be combined. The excessive loss can be claimed back from the reinsurer under an excessive loss treaty. In fact, a major proportion of the reinsurance recoveries of Darwin were made in this way. To summarize, there are two main types of reinsurance. Facultative, where the reinsurer assesses each risk and has the right of declinature, and treaty, where the reinsurer accepts all risks under the terms of the treaty. The three main forms of treaty reinsurance are therefore quota share, where the reinsurer receives and pays a fixed percentage of every risk or claim in a particular class. Surplus, where the insurer retains a share of each risk and the reinsurer takes the surplus. The losses are recovered in the same ratio as the premium ceded on an individual risk basis. And finally, non-proportional, where the reinsurer is required to meet the claims in excess of an agreed sum in exchange for a premium. These are the basic principles of reinsurance that provide the structure for insurers to meet their obligations. Risks need to be spread to meet world disasters. Reinsurance not only spreads risk, but assists companies in building their capacities to service clients and give their shareholders financial stability. In every field of human endeavor, reinsurance provides protection against loss from disaster.